I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. When I spoke to you last week, I proposed the idea that the market had set itself up for potential disappointment. I don't know whether the market is going to fall or continue falling or rise next week, the week after, or the week after that. But I do know that if you focus on quality, the other subject of last week's video, and value, you'll do well. The second part, value, is the more challenging part of investors to follow in a disciplined way because it requires patience. It requires standing aside sometimes when the market surges ahead. So what is value, and when is a stock or the market cheap? Well, there's no right answer to that. There are multiple models for determining value. There's excess return models, two-stage models, H models, sum of the parts models. There's so many different ways, and even PE ratios, so many different ways to estimate the value of a business. What is important is that you have a framework for thinking about when a company or the stock market might be cheap. That framework should be able to help you navigate through the market's various storms and sunny periods. Without knowing what the market's going to do next, you can still have some confidence that you're buying at a great price. Now, some of you may not have seen our recent blogs on this subject, so I want to talk to you about it for those that prefer to listen rather than read. If I buy and sell a stock on the same PE ratio, whether it be over 3 years or 4 years or 5 years, whatever the period is, if I buy that stock on a PE of 10 and sell it on a price to earnings ratio of 10, my return will equal the earnings per share growth rate of that particular company. So if the earnings per share are growing at 15% and I've bought the stock on a PE of 10 and in 5 years' time I sell it on a PE of 10, then I will receive an IRR, an internal rate of return of 15%. Now, why is that important? Well, number one, recently, back in June, stocks became very cheap simply because all of the collapse in the share price was related to PE compression. PEs came down, but the earnings for many companies did not. And last week you might remember I spoke about REA Group, a business that even in the face of intense competition manages to be able to lift its price and continue to generate rising revenues and rising profits. So finding those quality businesses that are going to grow their earnings over the next 3, 4 or 5 years is vital. But coming back to the question about value, PE ratios are not necessarily a measure of value. They are a measure of the popularity of the stock market. Now, in terms of a very simple framework, Warren Buffett suggested to us, be greedy when others are fearful, and fearful when others are greedy. PEs represent the popularity of stocks or the popularity of the stock market. So if PEs compress by 30, 40 or 50%, you can be fairly certain that stocks have become unpopular and it might just be time to sharpen the pencil. Taking the framework one step further, what if over the next 5 years, after we've bought when stocks were unpopular, they became popular again? And they will. Well, your return will be much better than the earnings growth rate of the company because you'll also collect the profit from the re-rating of the stock. And finally, can we be comfortable buying if the PE's dropped 50%, knowing that it might fall even further? Well, let me give you one simple example. If you buy a company whose earnings per share grow by 15% per year over the next 5 years, well, of course, if the PE doesn't change, your return will be 15%. If, however, the PE compresses by a quarter, by 25%, your return over 5 years will be 9% per year if you continue to hold that company whose earnings per share are growing at 15% per annum. And finally, where do you start losing money owning this business on a PE ratio of say 10 that grows its earnings at 15% per year? Well, you don't start losing money from that investment until the PE contracts by more than 50%. If the PE contracts by 50%, you have to hold the stock for 5 years and it needs to grow its earnings by 15% per annum for you to break even. Now, it's very likely that even if the PE contracts by 50%, over 5 years it will probably go back up again. So that's an idea for a framework for thinking about PE ratios or thinking about value, whatever way you want to value companies, but knowing that there's a great buffer if you're buying businesses that are growing strongly. So stick to quality, as I said last week, look for value as we're talking about this week, and next week we'll add a final element to this trifecta of investment insights. So thanks for following us on Facebook and Twitter in the meantime, and I'll see you again next week.